Stocks are high. Hey everyone, it's Wolfgang. So the stock market is on a run. We have been experiencing consecutive highs in the stock market for the past several days. So let's talk about that, because if you have investments in stocks, or if you're considering investing in stocks, this will help. This will put everything into perspective, okay? So today, the NASDAQ closed at a new record high, 22,844. The Dow Jones Industrial Average, DJIA, closed at a record high, 46,519. The S&P 500 index also closed at a record high, 6,715. So if you have stocks or you're thinking about buying stocks, you have to pay attention to market conditions, right? Because how do you know what to expect, basically, going forward in the near and longer term future? So stock buyers are buying stocks. I mean, the reason these indexes are closing at record highs is because people are buying stocks in those indexes, right? Why? Why are they buying stocks? Stock buyers are expecting lower interest rates are coming. They're probably correct too, okay? Lower interest rates will have to come now because ADP revised job conditions downward for the past 2 months. So lower interest rates will stimulate the economy because lower interest rates makes borrowing money cheaper. And companies and people will borrow more if rates are lower. Not everyone, but a portion of the public. When interest rates drop a little, a portion of the public and a portion of businesses will take out more debt and buy stuff. When interest rates drop even more, a larger group of people will jump in, take on more debt, and buy stuff. People and businesses. That's how it works. Lower interest rates stimulate the economy in that way, okay? So stock buyers are expecting interest rates to keep dropping. ADP is a payroll processing company, huge. It's the industry leader. And they keep revising job conditions lower. They're dropping job, hiring. It's not too healthy. Not in most of the or in a noteworthy portion of the economy. Okay, hiring is not too great, but there are some sectors where hiring is fantastic. Right? If you're in technology, certain parts of manufacturing, there are certain sectors that are hiring. Some sectors are not hiring. Okay, so ADP is revising its data about job losses for August and September lower. They're saying many fewer jobs are being created in this economy. And that's why stock buyers believe interest rates will drop. They are correct. They're probably right. So even though the government shutdown is affecting the data releases by the Bureau of Labor Statistics, the BLS, those numbers have not been reliable. They just released fairly recently in the past several weeks, they announced that 911,000 jobs had never been created. Over the time that they were reporting jobs had been created, 911,000 jobs, poof, just kind of vanished. So the BLS numbers are government numbers. ADP, they are touching real employers. They're processing payroll information. So they actually know the truth. The government, they collect data, but the government is, the Bureau of Labor Statistics, they are not running payroll for large numbers of companies. ADP is. ADP is closer to the metal in terms of hiring and firing than the government can be. The government is always going through intermediaries to collect the data. ADP is actually selling services to people who hire and fire people in the U.S. economy. So ADP is saying the job market is not too swift. So let's talk about the shutdown a little bit, how stocks are affected. Stocks are at record highs. How do government shutdowns historically affect the stock market? There's some good news here, okay? Since 1976, all the shutdowns since 1976, that's about 50 years, almost 50 years, stocks rise in shutdowns. So say what you want about the reasons for the shutdown, or, how we got here, how long it might last, and all the drama and the chaos with the shutdowns. But for the past 50 years, stocks have done pretty well, right? So here we are at record highs on these indexes, the NASDAQ, the Dow Jones, the S&P 500, and we're in a shutdown, and stocks tend to rise during shutdowns. So that's pretty cool. It's not cool that parts of the job market are not too good, but we're talking about stocks, right? Should we hold on to our stocks? Historically, stocks have risen in shutdowns. So it's probably a good idea to hold on to at least a portion of your stock holdings. Okay, so when the stock market jumps to high levels, that can make some people start to suspect there's too much speculation and turn those kind of people into sellers of stocks. Market tops create sellers, right? Some people want to sell. They say, well, it's been going up too much, too long, and the stock market's too high. I'm going to sell. So nothing wrong with that, right? If you just have a feeling like you want some of that, some of the stock ownership converted back to cash, selling at a market top is a good time because prices are high. What if they go higher, though? Because you need to check earnings. If earnings are rising, stock prices will rise too. So there are some sectors of the economy where earnings are rising. And you have to check the sections of the economy that you're invested in and find out if earnings are rising. If earnings are not rising, that might be a good time to take some chips off the table, to sell some of your stock. That's just one option. Let's talk about the options. If you're one of these people who gets a little bit, nervous about the market top, what can you do with your stocks at the market top? Okay, you can sell covered calls on your positions. You can sell covered calls. A covered call requires a margin account. You have to sign up for one of those. You have to jump through some hoops to prove that you're worthy of having a margin account. If you have a margin account, you can sell covered call options. That gives people a right to buy your position if it rises to a certain level. So you say to yourself, well, I own 100 shares at $50. If it rises to $60, I will sell it because that's gone up quite a bit. You can sell an option between $50 and $60, say, or several options, different options, so that if the stock rises above a certain level, someone has paid for the right to buy that from you at that price, at the higher price. If it rises from 50 to 60 and you sell options, covered call options, that gives people a right to buy at 60, they will buy it. I mean, I've done that. I've got experience using options, and you make income, right? When you sell the covered calls, you make income. So what that does is this. While it exposes you to the risk of losing your stock if it does rise to 60, say, from 50, if the stock falls, you have collected income from someone who bought the covered call, so your loss is not as severe. So you can sell covered calls on some or all of your position you're holding. And or you can sell a portion of your holdings. It doesn't have to be a black and white, all or nothing issue. You could say, I have $1 million worth of an exchange traded fund that invests in technology. I'm going to sell 500,000 of that exchange traded fund, that ETF. I'm going to convert half of my ownership of that ETF into cash and let the other half keep riding with the market. That's another option. It doesn't have to be an all or nothing, black and white sort of thing, right? And then you have $500,000 of cash. You have to redeploy those proceeds, right? You have to, if you're one of these people who says, I'm selling half my holdings, the market is high, I've got 500,000. What do I do with the 500, right? Where do I put the proceeds of the sale? Okay, one option is treasury bonds. If you can get into a treasury bond now or a CD at 4%, that's kind of the market rate, or a little bit less. I've seen 3.5% to 4%. And then you can wait for the market to fall and then buy back in when the market does fall. Because the whole thing is stocks are high right now, correct? We're at record highs on all these indexes. People get nervous and they say, I'm going to sell. So you sell half your position, you have 500,000 in cash, you buy treasury bonds or CDs right around 4% or whatever you can get, close to that. You wait for the market to fall. The problem is, how long are you going to be waiting? What if the market keeps going up? What if these record highs are nothing? 6 months from now, this will be in the rearview mirror. The AI boom has taken more and more of the economy much higher because the United States is at the cutting edge of artificial intelligence. The US leads the world in that technology. It's pretty new. It's only been around since 2022, ChatGPT, right? There's no telling what's going to happen with the stock market. As Warren Buffett has said, no one can predict the future of stock prices. So how long will you wait? If you sell half of your position, you have half of your investment in cash now, earning 3.5%, 4%. How long will you have to wait? There's no way to know. It could be a long time. And meanwhile, if the stock market keeps going up and up and up, there will be self-recriminations, right? You'll be saying, maybe I should have only sold a quarter of my holdings instead of half. So covered calls is an option besides selling a portion of your position But this sort of problem, we don't know when the market will go down. If we sell now because the market's high, it might keep going up. So many people say do not try to time the market because you can't read, you can't see the future. Nobody can predict the future. So what you can do is decide, I'm going to stay in the market all the time. And you can dollar cost average into your investment. You can dollar cost average. You can buy a little of that exchange traded fund, that tech-based exchange traded fund, say, as an example. Buy a smaller portion when its price is high, but buy more of it when its price drops. And then over the long term, if instead of a technology ETF, let's say you buy the S&P 500 exchange traded fund, and you hold it for the long term and you dollar cost average into it, your rate of return will keep up with the market, which has been pretty decent for quite a long time. So it's a very tough thing to watch the market fall, but it could be even tougher to sell a large part of your holdings and watch the market go up. So if you don't try to time the market, if you dollar cost average and just hold on to your assets and say, I don't need that money anyways, I'm going to keep it invested and I'm going to buy more when the price drops, that might be the best of all worlds. Now, I want to say something about, what sort of assets to buy. This is not a recommendation to buy individual stocks. Personally, I don't recommend that. I stopped doing that a long time ago. Mainly buying something that has a broader market exposure, like a technology exchange traded fund, the S&P 500 index, and an ETF that tracks that index is probably one of the best things you can do. Individual stocks, wow, you're really, that's a lot of risk. I mean, some people have the time and the resources to do it, but even Warren Buffett, if you look at his history, he has not done superbly well with individual stocks. For example, look at his holdings of airline stocks, the airlines, United Airlines, Southwest Airlines. He owned a bunch of airline stocks. Boy, did he lose billions. He lost billions on those. So even if you have the time and resources to keep track of what individual stocks are doing, that doesn't mean you'll win. Buffett lost billions of dollars, and then he sold them at a loss, at a huge loss. So I don't recommend individual stocks. I recommend broader market exposure, exchange traded funds, S&P 500 index, and over time, if you dollar cost average, you can track the return of the market, which has been pretty darn good. Much better than the 3.5% to 4% you'll get with Treasury bonds right now. So just keep it in mind, stocks are at an all-time high right now. This creates a lot of sellers. Market tops create sellers. Do you really want to sell? You have to pay the capital gains on the gain. Do you want to do that? Probably not. That's a tax hit. Instead, do you want to allocate a portion of your net worth into an ETF that has broad market exposure and then dollar cost average into it and just hold it and not sell it? That's an option. If you have any questions about this, I've got direct experience with this for a long time. I'd be more than happy to answer your questions. I very much want to thank everyone for watching. Have a great day.